Hello and welcome. I'm Nadine Blaney from Ausbiz. Well, ETFs have revolutionized the way that Australians invest. They're now one of the fastest growing investment products in the world, offering simple, low-cost access to almost every corner of global markets. But here's the thing. While we often dive straight into investment ideas and portfolio strategies on Ausbiz, we don't always stop to unpack the fundamentals. And whether you're buying your first ETF or your 50th, understanding how these products actually work can make you a better investor. May I also say that the best investors aren't afraid to revisit the basics. In fact, they know that's often where the biggest edge comes from. And that's exactly what today's session is about. We're cutting through the jargon, decoding the ETF universe, and giving you the knowledge to make more informed investment decisions. So joining us is DP Wealth Advisory's Andrew Wielandt, better known around here as the ETF Whisperer, to explain how ETFs have evolved, what's available, and what you should look for before you buy, mistakes, and where some of the biggest opportunities and risks lie. We'll also be taking your questions live throughout the session. So if there's something you've always wanted to ask about ETFs, now's your chance. Andrew, a very warm welcome to you. And because I really want this to be very interactive, I thought that we would start with a viewer question right off the bat. So this one comes from Stuart. He says, are you fully independent, Andrew, from the ETF industry? That's what I thought would be interesting to start with.
Sure, great question. Thanks, Stuart. And before I answer Stuart's question, hi everybody, and thanks Nadine and the Ausbiz team for putting this event together today. So Stuart, yes, I'm not sponsored by any ETF manufacturer. It's a family-owned business that I work for. My wife and I own the business. So certainly we have no affiliation or connection, have close working relationships with the various ETF providers, but certainly no ownership or anything like that.
All right, now that we've got that out of the way, Andrew, let's get to it. And we'll start by setting the scene. Why are ETFs having such a moment?
Yeah, it's a good question, and it's one that's been building certainly here in Australia for 8 or 9 years, probably longer. Here in Australia, there's now around 480 ETFs that are listed on the ASX, and CBO, I should say, and worth close to $350 billion. And there's some projections that it could go up to $400 billion by the end of this year globally. Looking at about $23 trillion of assets with ETFs. And I think there's a few reasons. One of it, Nadine, is the fact that they are so easily accessible now that you can literally, with your phone, go online and you could be purchasing a basket of shares within an ETF. I think another thing is they're actually quite simple in the context, and again, that's a very broad sweeping statement, but really when you're buying an ETF, you're just buying a basket. Now, what's in that basket, that's a whole other story. And then probably the final thing, of course, is the cost piece. And the costs of ETFs, in particular, if we're talking passive following an index, they're incredibly cheap for what you're getting. So I think, between access and cost and simplicity, that's really what's driving the market, not only here in Australia. Australia's got one of the faster growing ETF markets in the Asia Pacific area, but also globally as well. We're seeing that real uptake. And in fact, in the US, there are now more ETFs than there are listed shares.
Yeah. So do you think the growth is being driven by retail investors, by advisors, by institutions?
All of the above. Certainly, initially, it was individual investors, a little bit of institutional interest, but certainly over the last, I'd say maybe 3 to 5 years, there has been a lot more interest in that institutional space. And so really, we're seeing broad interest, which again, coming back to sort of how much the market is growing. Some people are suggesting that ETFs could grow by 30% globally over the next couple of years. And if that's the case, then that wouldn't be just from one particular aspect. It wouldn't just be for institutions or from mums and dads, retail or institutions. It would have to be everybody sort of moving in that one direction.
So, Andrew, let's bring it to the moment. Like, why should investors care about ETFs now?
I think, Nadine, well, without being Captain Obvious, it's a tricky environment that we find ourselves in at the moment, if I can put it so delicately. Every morning we wake up and we wait to see what sort of news is coming across our screens relating to either the geopolitical space or whatever else is going on in the world. And in the past, your sort of 1990s style stockbroking, I'm going to buy 8 to 12 different direct shares, Australian shares as an example, might have been good for the 1990s, but I think anybody today would sort of, even though we might long for the 90s, that's not really the world we're in at the moment. We sort of need a world in which is more, we're living in rather in a world which is more complex and therefore needs a more sophisticated solution. And a sophisticated solution is an ETF or a portfolio of ETFs. It doesn't have to be just ETFs, it can be part of the toolbox. But ETFs allow you to solve for a number of different issues, Nadine, in particular diversification, that you just don't have those 8 to 12 blue chip Australian shares, your 4 banks and your 2 miners and your 2 retailers and your telco and your healthcare company. You now can have all of those captured plus 190 plus others in one ETF. And that's your Australian exposure covered. And then for your international exposure, your and all some of the other asset classes as well. Because I mean, I love Australia, Nadine, but I think about what we've got going on here in Australia relating to technology and the investment in technology, and it is absolutely dwarfed by what is occurring offshore. And as a father of a 14-year-old, I'm incredibly mindful of all those things. It's not going to be coming from her future isn't going to be sort of coming from bank profits or mining companies sending boats of iron ore off to China. It's going to be coming from AI and from tech and cybersecurity and all these other areas. So from a diversification point of view, from an investor's point of view, having exposure to a broad range of assets at a low cost in a simple structure is certainly the way that investors should be thinking about it.
Well, you've got a 14-year-old. Now I know why you were talking about the 90s being back. We'll leave that one there and talk about the ETF universe. Do we even know how many different types of ETFs are out there?
If I was better prepared, I could have given you a rundown number by number. But look, at a very high level, you can have your building block ETFs, for the want of a better term. You could have like your Australian equities exposure. You can have your international equities exposure. You can have your fixed interest exposure, and you can have your cash exposure. Like that would be sort of your starting point. And then do you think about, do you want ETFs that, as I spoke before about, property or infrastructure, is that something that you might want to think about? And all of those together would sort of form your core. And then, and generally speaking, and I know we had the general advice disclaimer that popped up on the screen, but for those who weren't paying close attention, everything we're talking about today is of a general nature. This isn't personal advice. So within that core, it'd be around 60-70% of your portfolio, probably closer to 70%, 2/3 of your portfolio is core, and then 1/3 might be more thematically focused or might be more actively focused. And that's sort of, before, as I was mentioning, whether you're interested in technology companies or whether you think gold's something of interest or whatever the case be. 2/3 core, 1/3 satellite. And then to my earlier point, 483 ETFs. Most of them would actually at this stage in Australia be passive, but there is a growing trend in active.
We're going to go through all of that, but I just wanted to rewind for a moment because we're sort of building up here our knowledge base. Equity ETFs, so those are particularly focused on pure equities, but you're not an owner of the actual shares.
Well, indirectly you are, because it's owning a basket, but at a high level. So let's pick on the ASX S&P 200, the broad Australian share market. And there's about 5 or 6 different ETFs that you can buy from various providers that allow you in one trade to buy all 200 companies on the ASX S&P 200. So instead of buying BHP and Rio, et cetera, one ETF will allow you to buy all 200. So you are an indirect owner of all 200 of those businesses. And so if that's the case, then what you're actually doing is you're giving yourself broad exposure to the whole share market, but in one trade. So that's, and similarly with international exposure, again, if we're talking passive, the most followed index is the MSCI, the Morgan Stanley Capital Index, and there are a number of passive ETFs that literally just try and follow that index as well, and they do it at a low cost.
Now, there are fixed income ETFs as well. When do they make sense?
So in the context of diversification, they make sense. So again, if you have a portfolio just full of shares, well, that's great. But if we have a moment whereby there's a pandemic or there's a global financial crisis or, whatever issue there is in the world at any one particular time, that is unhelpful. You're going to see a lot of volatility in that portfolio. So what some investors do, most investors do, is they add in fixed interest and/or they add in a cash ETF, because there are a number of cash ETFs that you can get exposure to as well. And the idea of those, Nadine, is they add diversification, they help act as a shock absorber so that if there's volatility in the share market, then those fixed interest ones, or certainly the cash one in particular, barely moves at all. Subject to what type of fixed interest you have, it moves around a little bit. But of course, the flip side, Nadine, is if the share market's on a tear and everyone's loving the market, they're not going to move a great deal, so they're actually going to act as a bit of a handbrake. So you've got to work out, do you want lots of volatility? You'd hold less of those styles. Do you want less volatility? You'd hold more of those styles.
So we've got equity ETFs, we've got fixed income ETFs. I heard you say cash ETFs. So beyond those sort of basics that I think that most of our viewers would understand in a broader portfolio context, in ETF land, you mentioned diversifiers. So you could get commodity ETFs, sector ETFs. Just walk us through some of those bigger diversifiers.
Yeah, and probably the most popular one at the moment, well, up until about 3 months ago, was gold ETFs, where you could actually buy either a gold miner ETF, and Henry Jennings and I on the calls had spoken about those at some length, the pros and the cons of those, or you can actually have just an ETF that buys physical gold and it sits in a vault somewhere, be it in Perth or in London or whatever the case may be. So again, acts as a diversified. In that particular case with gold, doesn't pay you an income at all, but if the world's going a little bit silly, then potentially that diversifies your portfolio. I spoke before around infrastructure as an example. So if you live in Melbourne, and I've been lucky enough to travel to Melbourne a little bit over the last year or so, lots of roadworks going on, lots of tunnels being built, lots of bridges being built, and as a consequence, there'll be tolls on some of those assets. Those tolls give predictable, reliable income. They can act as a diversifier in portfolios. Property focused ETFs could potentially be another diversifier as well. ETFs that track, and so here in Australia, there's a prominent one that owns the top 25 or 30 top listed property trusts or real estate investment trusts here in Australia. So again, sticking all of those in your portfolio, dependent upon what the weighting is, and sort of how they all work together, how they work in concert together, will sort of give investors a more diversified return, help smooth out returns so you don't have the big peaks and falls. But as I said, in times of market euphoria and everyone's feeling excited, will act as a bit of a handbrake. But when everyone's hating the share market, you'll be wishing you had more of them as well. It's your tolerance to risk.
Maybe we'll get to when it makes sense to get more specialized in that core versus satellite a little bit later. But I think just again, taking a bit of a building blocks approach here, passive versus active. What is the real difference?
Well, simplistically, Nadine, fees. That's really, well, that's not entirely true, but just so again, if you look at a passive Australian share market ETF, it's going to have a fee of somewhere between 5 and 7 basis points per annum. So in other words, 70 cents for every $1,000 invested. It's incredibly cheap. Whereas if you have an active ETF, the guys and girls who are trying to beat the market, they may have some secret sauce or some rules-based thing which they believe outperforms the market, they generally tend to have a much higher fee. So really, from an investor point of view, you've got to turn your mind as to, do I think our investor can beat the market? No, then I should probably steer more towards passive ETFs. Or do I think that, I have a particular bias towards technology or gold or infrastructure or, whatever particular area that you think the market will move towards? That's a more active approach. So therefore, you're going to pay more for that. And I should briefly also mention that S&P Global rather, have got a study out, the SPIVA report, if you want to Google SPIVA, and it talks to active versus passive management. And what it basically says is, over the short term, active can outperform passive subject to market conditions. But if we look at over 15, 20 years, it's pretty tough for active to outperform passive when you take into account fees. So again, when we're building portfolios for clients, it's really sort of saying you have a core, which generally tends to be lower costs and passive, and then subject to what's going on in the world at the moment, that's where you have those tilts, those active tilts. But those active tilts change subject to what's going on in the world.
So thematic ETFs, that's another term that is thrown around. I would assume they can act as diversifiers, but they're a little bit different, aren't they?
Well, they are. So again, if we're continuing our fee conversation, and just to be clear, you should focus on fees, but fees isn't the only thing you should be focused on. But if we're in that lens, these thematic ETFs generally tend to be a bit more expensive. The average one, and I'm just picking a number here, it's 40, 50, 60 basis points relative to that 5 to 6 basis points for your passive track the low index. So you can see it's significantly more expensive. But before we were talking about, you may think that cybersecurity is a thing, or you might think that technology is a thing, or you might think robotics is a thing, or whatever the thematic that you think is a thing. There's an ETF out there generally, or if not, I'm sure there will be very quickly, that can help solve for that issue. So again, coming back to core and satellite, the sort of thematic ETFs would actually sit in that basket, whereby they're sort of acting as in part a diversifier, but they're also a tilt or a nod towards where you think there's a particular area of interest. So as an example, last year, Nadine, gold and silver, they went incredibly well, whereas this year, not so much. So again, you've got to be, in my view, very careful. Don't overexpose yourself to these thematic ETFs, because they tend to be, when people love them, they love them, and when people don't like them, they don't like them. As opposed to a passive, generally all weather, just follow the market. I'm not suggesting the market doesn't move around, but you don't tend to see the extreme volatility that you can see on the up or the downside with some of these thematic ETFs.
Andrew, I often hear smart beta talked about. It sounds complicated. What is it?
I'd actually use the term, and certainly you're right, like that's one term that's thrown around. You may have heard me or others on Ausbiz talk about factor-based ETFs, so I might use that language, but they're interchangeable. And a factor-based ETF is one in which shares are the drivers of return with shares. You can break down into a number of different areas. It can be it can be income rather. It can be value, it can be growth, it can be quality, it can be momentum, it can be low vol. So there's a number of different drivers of share performance. And so factor ETFs tend to really drill in on a particular area. So take growth ETFs. Growth ETFs have really had their moment in the sun when they've been exposed to technology and whatever the case may be. Whereas value ETFs have had a tougher time of it, because no one wants value at the moment. Everyone wants tech and so forth. And that's really fits into that growth space. We saw over the last couple of years, quality ETFs performed quite well, but over the last 6-9 months, they haven't. In Australia, one of the stronger performing factor-based ETFs, or not performing from an interest point of view, flow, there's actually been income, because Australian investors love income. So instead of, again, them trying to buy their big four banks and whatever, you can buy an ETF that has an income focus that might hold anywhere between 40 and 60, 40 and 70 different income focus shares. So smart beta, factor-based, looking across a whole range of determinants of share prices, and, as I said, quality, momentum, etc. as examples of those.
Look, I've put you through your paces already. I think maybe we should get to some viewer questions. And this one came in before the event from Austin. And I will dovetail into a question from William that's just come in as well. So Austin writes, how do ETFs differ from an indexed managed fund? And William wants to know as well the main differences between an ETF and a LIC. So I think people trying to get their heads around how they sort of differ from some of those products that are out there.
So we might deal with the managed fund question first. Yep. So again, if we go all the way back and we had that historical conversation, managed funds were a thing. Managed funds are still a thing. They're just not much of a thing anymore because people want ETFs. So the difference between an ETF and a managed fund generally is they are the same, albeit there might be some mechanics behind the scene that are different, but generally they're following an index or whatever the case may be in the case of this question. The key difference is one's traded on a market and one isn't. So, and therefore, if it's traded on an exchange, you generally tend to find that the MER, the management expense ratio, the cost of operating that fund, or you owning the fund, tends to be sharper, smaller when it's on an exchange because there's more competition. You can choose between 4 or 5 different providers, or if it's an index, well, you're dealing directly with whoever the index provider is. So usually the fee, not materially high, but the fee generally tends to be higher. So that's the key difference. Traded on exchange, and that MER, the management expense ratio, generally tends to be cheaper. The other key thing is that they also generally trade at NAV, at net asset value, so $1 is $1, which is an important point because if we come to the second question from William, I think you said.
Yeah.
And thank you, Austin, for that first question. So William's question is, what's the difference between an ETF and a LIC? So a LIC is a listed investment company. So basically, one of the key differences between a LIC and a ETF, so LICs generally don't follow an index. It's managers taking a particular view on of an underlying investment. And they generally trade at a premium or discount to their net asset value, their NAV, whereas I just mentioned before that ETFs, $1 is always $1. You may not like the price of where the underlying investments are, but you're buying $1 worth of assets with an ETF, whereas if I'm buying a LIC, I might be getting $1 worth of assets for 90 cents of value, or it might be $1.10. They generally tend to have a different price range, if I can put it that way, and the cost of running a LIC, listed investment company, also tends to be more expensive as well. Not always, but generally. LICs used to be huge. So when I first started, you had companies like Argo, Australian Investment Company, Milton, Degeroa, but certainly over the last 5 to 10 years, much less interest in the LIC structure, and a number of them are trading at a discount to their asset backing, which potentially says there's some value in those, subject to what they're doing, not the ones I mentioned. Whereas ETFs, far more interest, obviously better marketing, if I can put it that way. And if you look at someone like Jeff Wilson from Wilson Asset Management, very astute marketers, and have done a really good job in promoting their listed investment companies, and the performance has been okay too. But that's probably another thing as well, that people are far more aware of ETFs because of the marketing piece, whereas the LICs, all the issues that I just raised, haven't really marketed themselves as well.
Now, Andrew, we'll just do another question before we move on to actually, maybe you can give us a little insight into your process. But Roberto has written in and he says, could you please explain when and how the management fees and similar are charged?
So again, ETFs, nice guys and girls, but they're not doing it for nothing. They're running a business. But subject to what they're doing, in other words, are they running a passive fund? What type of index are they following? Do they have to think about where the Australian dollar is? So we'll talk about hedging a little bit later on. There is certain considerations in what is required to run the business. And so they charge what's called a management expense ratio, or an MER. And as we spoke about before, generally passive ETFs have a lower MER. Active ETFs generally tend to have a higher MER. Not exactly the same, but generally the rule doesn't hold all the time, but generally. And those fees are paid by you before you receive your distribution. So, hypothetically, an Australian passive ETF is paying you in your hand a 3.7% per annum return. They would have taken, again, we'll just make it simple, 5 basis points as a fee. So in fact, if they hadn't charged you a fee, you would have received 3.75%. They've kept 0.5 or 0.05 and they've given you back the rest. Mm-hmm. So it's a function of how much it costs to run the fund. Whenever, and I should have said this right from the get-go, Nadine, it's an important point. When you're looking at an ETF, go to the provider's website and look at a thing called a target market determination, a TMD. And the TMD will talk about what style of investor should hold it, what's the volatility. It's about 5 or 6 pages of really interesting information. The other thing you should turn your mind to is there'll be a profile, 1 or 2 pages, and on there it'll talk about what their MER is. And the other document you should turn your mind to if you want to do the deep dive is what's called the PDS, the Product Disclosure Statement. And again, all of these details will be in there too, but certainly as a bare minimum, the TMD, the target market determination, and the fly or the profile, and it will talk about what the fees are. So just to be clear, no one sends you a bill at the end of the year. It just means you're receiving that little bit less of a distribution because the ETF provider has held that back.
Or we could get somebody like you to help us with that, right? But now that you've led us there, we'll take a look a bit under the hood at your process. So how do you analyze an ETF? Clearly you're very knowledgeable about the product, about their intention, about what's out there, but where do you go first when you're trying to analyze an ETF?
Yeah, thanks, Nadine. An easy one. And look, I'm in a fortunate position whereby, back to, I think it was Stuart that asked the first question relating to my involvement with the ETF providers. I have really easy access to all of them, and they're very forthcoming with information, which helps make my job easier.
But do you start right away, Andrew, with performance? Like, how do you even separate, where you put your focus?
Yeah, it's a good point. I'd actually take it back a couple of steps. I'd actually say, first of all, how much risk am I willing to bear? So, a hypothetical investor who's a balanced investor, okay? So a balanced investor, and we could spend an hour on what a balanced investor means, we're not going to do that. But my view of a balanced investor is 50% of the assets go into growth assets, Australian shares, international shares, property infrastructure, and 50% goes into fixed interest bonds, cash, that type of thing, maybe gold. So that's what a balanced investor looks like. So if I understand the frame of the asset allocation, the next layer down is I would then look at each bucket, for the want of a better term. So in the Australian bucket, I'd ascribe a certain percentage and I'd say, okay, do I want to have a passive exposure? These are the different passive providers. Do I want an active exposure? These are the different providers. And then once I've ascertained whether I want to be active or passive, and remember we spoke about that core and satellite approach, I'd then say, okay, well, predominantly for Australia, I'm probably going to want to be more broad-based. I probably want to be passive. Who are the passive ETF providers that I should be turning my mind to? Or do I want to have a diversifier in there? What's available there? Once I've identified, the 2 or 3, I'm then looking as to which index they're following. Is it the index that I think is an appropriate index to be following? What's their fees? And then to your point, what's the performance? And the other thing that I would be interested in is what's their maximum drawdown. So in other words, when things are going to hell in a handbasket, how much have things pulled back. It's really interesting to focus on how much money they've made when things are good, but equally so, how much pain has there been? So in my world, we're looking at that sort of drawdown, because it's interesting if someone's made a 40% return, but if they've taken 40% risk in which to do that, well, that's probably less helpful. So without turning this into an ad for me, when I'm doing it, what we're trying to do is drive market-like returns, but in our case, we try and take about 20% less risk in doing so. So as an example, in our model, sorry, Nadine, in our models, we're underweight US tech and we're overweight cash. So that's how you'd sort of, you'd go, how much risk, what are the buckets, and then those criteria that I spoke about.
Well, I was going to ask about liquidity, but we have so many questions coming in, and we had Pete writing in before this event with a question along these lines. Ray also just writing in saying, are there too many ETFs now? And this is, I think, the crux of a lot of questions out there. If there is a downturn in the market and everyone is trying to get out, could ETFs cause a very quick market crash?
I can't look you in the eye and say no, but I can give you a few reasons why I don't think that would be the case. So, and again, the frame in which I'm answering this question is passive. So again, remembering if we're talking Australia, it's the top 200. If we're talking the MSCI, the Morgan Stanley Capital Index, it's 12 or 1300 companies. And I sort of use a couple of lenses. I use the COVID lens. I use the Liberation Day lens, albeit that was only 3 days. But even if we go back, and bear in mind ETFs weren't so much of a thing back then, but even in GFC times where there was significant market pressure, then no. And in fact, in the case of things like fixed interest, the institutional market was actually using the pricing of bond ETFs as a proxy because some of the fixed interest markets were actually in dislocation. So I think the broad answer for passive is no. I'm not, I think Pete's question spoke about suspended redemptions. Well, again, if we're buying the top 200 companies, unless they're all suspended, the market's trading, it's functioning. I think where Pete's question might come to is if we start talking about some of those active, more niche ETFs, whereby there might actually be a much narrower market, and we don't see many of them here in Australia. In fact, I don't think we've got any here in Australia, but offshore, where there might be triple leveraged ETFs, or there might be the underlying asset class is illiquid. That's where it's potentially going to be a bit trickier. But certainly in times of market stress, ETFs have not proven to be problematic.
Mm-hmm. And they are liquid, just to clarify that point.
They are liquid because it's a fact. So again, because there's 483 of them, it's very hard to have a broad ranging conversation. But most of the ETFs on the market in Australia are passive. Mm-hmm. And so the actual underlying things that they are holding. So again, we just keep focusing on ASX, S&P 200, the banks, retailers, etc. They're all liquid. You might not like the price, but they are liquid.
So maybe we'll talk about a few red flags. Do you see any red flags, or is there anything obvious when it comes to management fees? Like, where do you look for sort of red flags that would make you look away or do some more research?
Oh, I mean, probably the first thing to do is what's the index that they're following? Mm-hmm. Again, if they're just, and I keep banging on about the ASX S&P 200, but it's one that I think everyone can relate to. If they're suddenly following an index based in the Netherlands that holds 500 companies, you go, well, not really, because I'm actually trying to buy the top 200 companies in Australia. A very poor example, but if it's literally just tracking the ASX S&P 200, I'm okay with that. If it's tracking an index that's not that, sure, there might be a reason they're not tracking that particular index as it comes down to costs, but the actual underlying basket still mimics what the ASX S&P 200 does. Fantastic. But if that index starts drifting too far away, then that starts becoming a bit of an issue. I think probably another thing I'd be thinking about is the buy-sell spread. So in other words, what's the gap? How liquid is that ETF? Is it turning over lots or is there a big buy-sell gap between the buyer and the seller? There's another thing called tracking error. So tracking error is how well is it actually following the index that it's trying to actually replicate. So if it's tracking too far away from the index, is that because it's holding too much? The ETF is holding too much cash? Is the MER, the cost, too high? So they're probably the key things. What's the index? What's that buy-sell spread? And what's the tracking error? That'd be three things I'd be paying attention to.
I, Andrew, always have a little chuckle when you see a new ETF come to market. Often the names are very creative. Often they say what's on, what's in the tin, crypto, for example. Do you have to be a little bit careful, though? Can ETF names be misleading?
I think in Australia we're not too bad, but at a very high level, and you asked me before as to what my process, one of the things I didn't say to you is, gee, it's got a cool name. I might pay attention to the name and have a little chuckle to myself going, nice one. But you've got to be really careful. Does it say what it does what does it say on the tin what it does? And so to that end, you've got to be really clear. Just because it's a really interesting name or even an interesting provider, what index is it following and does it solve the problem I'm trying to achieve? Whereas if it's got some interesting ticker and it's got a bizarre index that it's tracking and it's new, I'd just be sort of like, well, this is all really interesting. I'm just going to see how it's going to trade for a period of time. Whereas if it's an established provider and it's a highly liquid market in which they're following and they're joining a cohort of others out there, I'd be far more inclined to invest in that one earlier.
Got it. Can you own too many ETFs, Andrew?
Yes, I think you can, Nadine. If you look at, there's a couple of research providers that we subscribe to, and in their models, they've got around, I'm just going off the top of my head here, it's probably around 13, 14 ETFs. I think that's probably about right. If you can actually end up with too many and then they're overlapping, and even though you think you're getting diversification, you're not. So part of it, again, is being really clear, asset allocation, what problem am I trying to solve for? Different ETFs have different jobs. But yeah, having, 40, 50, 60, whatever the magic number is, apart from the fact it's just time consuming. But yeah, I would think, a high number of ETFs without understanding the correlation or the relationship between them could be tricky.
Okay, let's talk about some opportunities, shall we? And then we're going to have to get to some more viewer questions. What's exciting you the most in the ETF universe today?
Well, apart from the fact that they're really starting to take off, which is exciting because, one of my big things is around investor education. So I'm not suggesting every single person. There's 2 million of us, Nadine, 2 million Australians that actually now own ETFs. So to me, that's really exciting that we've actually got this broad interest in markets. So that's a tick. In the context of sort of the broader ETFs, we touched on it very briefly before, but factor-based ETFs or smart beta ETFs really aren't sort of getting as much traction here in Australia as they are offshore. And so to me, there's a big opportunity there, things like momentum ETFs or low volatility ETFs. Quality's been around for a little while here. Income's been here, but again, there's been iterations in that income, like covered calls as an example. So I think the market here is still actually quite immature. We have more direct shares than we have ETFs. So I'm really just looking forward to seeing a maturing of the market. I'm looking forward to seeing more of these factor-based ETFs come through. Some of these ETFs that have more of that institutional style focus relating to like maybe some capital protection. It's not here at the moment, but is that something like that coming out? But how much is that going to cost and how they're going to do that? So yeah, it's an ever evolving market, lots to look forward to.
All right, well, I know that a lot of our viewers have been looking forward to getting their questions put to you. So thanks to those that came ahead of time, one of which was hedged or unhedged ETFs. Which do you like, Andrew?
Yeah, it's an excellent question. And I would suggest that it comes down, well, a couple of things. If you so get back to our passive guys and girls, don't want to worry about the world, you just buy hedged. And what hedge means is it basically just protects you as to what the dollar is doing. So if the Aussie dollar is moving around, no biggie. Whereas if you have a particular view as to where you think the Aussie dollar is, and I should know where the Aussie dollar is, I think it's about 68 or 69 at the moment. If you've got a particular view as to where you think the dollar is, or going, I should say, then you may wish to turn your mind to an unhedged ETF. And where an unhedged ETF really comes into its own is if the Aussie, and it's an extreme example, but if the Aussie dollar was 90 cents, sorry, I'm not trying to trigger all the travellers out there. If the Aussie dollar was 90 cents and was going to 60 cents, and if you had an unhedged ETF, that would be to your benefit. However, if the Aussie dollar was at 60 cents and went back to its long-term 40-year average of 74 cents, that would not be to your advantage. So again, you're passive, you just let markets do what markets do. You would buy hedged. If you want to be more active, you have a particular view as to where the dollar is going, you would actually go unhedged. As a brief example, we had unhedged exposure in a particular US-based ETF or Australian-listed US-focused ETF. When Liberation Day came along, Aussie dollar went from high 60s to low 60s, may even hit high 50s. We actually sold that unhedged ETF, bought the hedged ETF, and as the dollar went back up to 74 cents, plus a recovery in US markets, we actually had a sort of a double win, if that makes sense.
Yeah, so you're active and you're not afraid to move in and out of ETFs, it sounds like, as well. Look, Stephen has written in, he says, is there a lag with the ETF price and what has happened overnight, for example, in the S&P 500 or the NASDAQ?
There is, Stephen, but you also need to turn your mind to the fact that most of the pricing for the S&P, if you're talking about that one, is actually based on the US futures market. So the US futures market's running all the time. So it's actually more, those styles of ETFs, the function is more of a function of the futures price rather than what occurred overnight. And again, if we're talking hedging, then also what's happened with the dollar as well. If it was unhedged, that's something else that you need to be considering as well.
Dan says hi. So hello to you, Andrew, from Dan. He says, regarding the new CGT rules the government has brought in, he has heard that ETFs might be a better option to minimize these taxes rather than holding shares and trading them personally. What do you think?
So again, we'll go back to our general advice disclaimer at the beginning, and I'll add a tax overlay on that as well. You should be having a chat to your friendly accountant about this, Dan. But from what initial analysis I've seen from a couple of ETF providers, that is certainly the feedback that they're seeing, or modelling, I should say, relating to, in particular, if you're sort of turning over that portfolio, your direct portfolio on a fairly regular basis, as opposed to a passive, hold, collect some income, that type of thing. So there's some interesting research pieces out there. I'd encourage you to have a read of them.
Okay. Here is another one. This is from Sam, who writes, who gets the vote? So you're effectively a shareholder, he questions, with no voting rights. Who gets your shareholder voting rights?
So it'd be, the ETF manufacturer who's sort of buying them on your behalf. They're the ones, if they choose to vote. And again, we've seen a whole range of shareholder activism and institutional, I'm trying to remember, I can't quite work how to phrase it, but there's institutional, you'd probably be interviewing them, Nadine, institutional shareholder firms that actually provide advice to institutional investors as to how they should vote on particular areas relating to pay performance or whatever the case may be. So the various providers would be taking their advice from those proxy forms, so they would be voting on your behalf.
Kevin writes, do you get franking credits if you, say, have a bundle of the ASX 200 companies in your SMSF? I think these are all great questions, Andrew.
These are great questions, and as you and I spoke about right from the get-go, Nadine, there's a threat that we might have to do a couple more of these,
Yeah.
because all we've done is we've whet the appetite.
Yeah.
Because there's lots of great questions. Yes, Kevin, you subject to whether the underlying ETF holds companies that it pays franking credits. That's obviously a really important point. But the ASX, from memory, around 60% of companies pay franked dividends. So short answer is yes.
Yeah. Should younger and older investors use ETFs differently?
That's an interesting philosophical question. Again, I come back to risk. I would suggest, without being ageist, that if you're closer to the finish line and subject to what you're wanting to do with your money, some people is, spend all my kids' inheritance, get stuck into it. Others might be, well, no, we've worked super hard throughout our life and we actually want to pass this on. So subject to what that looks like in your world, if you're more mature, that might speak to what type of ETF you might choose to, or strategy. In the context of the more younger viewer, listener, all power to you, well done to you, you have time on your side. So there's certainly more scope for you to consider taking on more risk. But again, it's got to align with how much risk you're willing to bear as well. If you're I've got a mid-20s client who, barely struggles to get themselves to balance, they'd actually probably prefer to keep the cash in the piggy bank. It's really what speaks to you and how much risk you're willing to bear.
Gosh, good on that mid-20-year-old already getting advice. That's incredible. Here's one from Sam. I don't know if this is the same Sam. I feel like we've had a couple from Sam. How often should a long-term investor actually rebalance their ETF portfolio? Every year, only with new contributions, or only when allocations drift materially?
Again, great question. Sam 1 or Sam 2, or whichever Sam is asking those questions. Sams, is that the plural? The collective noun. Thank you. Again, I think it was sort of to your implied question before, Nadine. You almost need to have some rules before you start, and they're your rules. They're not my rules or anybody else's. It's what rules am I as an investor going to do? Am I going to rebalance twice a year? Am I going to rebalance when cash gets over a certain level? To Sam's point, am I going to rebalance if, and again, hypothetical, Australian shares, I only want them to be 20% of the portfolio and they're now 30%. Is that my trigger to rebalance? So here within the business, we've got particular rules for particular portfolios at particular times. There's not a one size fits all, but certainly I think it's really important before you start, you need to know what your rules are. Similarly, and again, not trying to turn people into share traders, far from it, but sometimes you buy things and they don't work out. What's your rule there? Am I going to sell it if it drops 10%? Am I going to sell it if it drops 20%? You need to have some broad rules. You don't have to, but just before you start, what's your broad rules? Doesn't mean the rules can't change, but when you're going on a journey somewhere, I mean, I'm sure some people do, but most people go, I'm going to drive to the Gold Coast, or I'm driving to Newcastle, or I'm driving to Geelong, or wherever you're driving, you have a bit of an idea as to how you're going to get there, and you're going to follow a map. So it's a good idea just to have some broad rules. Doesn't mean you can't refine the rules, but think about that type of thing. So there's no right or wrong answer. Sorry, Sam.
All right, Andrew, I knew that we would get some questions from our viewers about, specific opportunities. So we've got a question from Sam W. saying, are there any active ETFs you genuinely think add value after fees? I would suggest, Sam, you go to ausbiz.com.au, watch a lot of the interviews that we've done with Andrew over really the years. But I've given you a bit of time to think. Any active ETFs that you genuinely think add value after fees?
Well, I might, Nadine, talk to you. And I spoke, it was a fortnight ago, no, it was a month ago, and we spoke about the future fund and how some investors can look at the future fund. So the future fund's Australian Sovereign Wealth Fund. It's only about 14% Australian shares. It's quite low, actually. But it actually has some active management in there. And are there a couple of ETFs that investors could turn their minds to in that regard? And one of the ones that I spoke to at the time was from Plato, PGA1. So that certainly might be one to think about. But just to be super clear, apart from the general advice warning, which I think I've given 3 times now, it is certainly one that is going to be volatile. So again, if we're in that sort of active space, when things are good, it'll be great. And when things are under pressure, it will come under, pressure. But certainly, and it's not adverse in charging a fee either, I might add. So certainly that would be one. The other one that Henry and I have spoken about ad nauseum are the guys and girls from Munro.
Wait, I know what's going to come. Mate. M-A-E-T. Nick Griffin, Chow Ma, super switched on people. I mean, everyone who works at Griffin super switched on, but, super switched on guys and girls. Charge, again, an appropriate fee. And they have a performance fee. It's not just a high fee, but they also have a performance fee, as does Plato from memory. But again, have delivered those returns as well. But we've got to turn our mind back to SPIVA as well, that S&P Global report. Just because they've delivered the returns in the past doesn't necessarily mean they can do into the future. So if you're going to do active, watch them closely. And if the performance isn't there and you can't sort of relate to that relative to the fee they're charging, then that's where you sort of say, well, that was really interesting. Maybe I should look at another provider. Well, Andrew, we have covered a lot of ground. You have done a lot of talking, and we really appreciate all the insights that you've shared. If there's one key message from this Decoding the ETF Universe conversation you'd like to leave our viewers with, because we're still getting questions coming in, so I thought maybe just, parting word from you.
Well, thanks for the opportunity. But yeah, I think really it just comes down, and we covered off on a number of these points, but if I could summarize it very quickly, it would be, what are the rules? As in, what are you trying to achieve? How much risk you're willing to bear to get there? Looking at that blend of active versus passive, how much cost is going to be involved in doing that, and having a rule book as to how you're going to go about it, how you're going to execute it, what platform are you going to use, how regularly are you going to look at it, when are you going to seek advice, if at all. You may be comfortable doing it yourself. What are the triggers that you may want to go and seek advice on? I think if you sort of have that robust plan or map and just keep revisiting that, then it's difficult to go wrong.
And you expect the Australian ETF landscape to continue to mature, to continue to evolve. We're still playing catch up with some other parts of the world as well.
We are but amateurs compared to the rest of the world. And yet, as I said, Australia is one of the fastest growing areas for ETFs in the Asia Pacific region, but we are well and truly behind the US. Now, again, slight tangent, I don't want to get to the point where there's more ETFs than direct shares. I'm not sure that's helpful. And I certainly don't want to be getting into a world of triple leveraged ETFs. That's another area that I'm not particularly interested in Australia getting exposed to. But, there are, I haven't checked recently, but when I last looked at the US, there was something like 7,000 ETFs in the US. There's 483 here. Mm-hmm. So there is still plenty more opportunity for investors. So again, if you have never looked at an ETF before, plenty of great resources, obviously on Ausbiz in particular, but even places like the ASX, they do some really good educational pieces. Money Smart from ASIC, they've got some really good educational piece there as well. Make sure you've got a broad basis of education before you start doing this.
Well, you've educated us today, Andrew. We call him the ETF Whisperer. Really appreciate you joining us today and decoding the ETF universe.
Thanks, Nadine.
Take care. And that's the session. We hope you learned something. We hope you enjoyed it as well. We'd love to do more of these sessions in the future, so if you found it valuable, feel free to drop us a line on your screen right now. Thanks for watching.